So, Polar Capital Global Financial Trust. I'm one of the sort of three co-fund managers. At Polar, we run three financial funds, and the investment trust was launched back in 2013 as a lower risk way for investors to get exposure to global financials. Income and growth mandate, yield at 3% at launch. Obviously, with the recent fall in markets, that's about, not 2.6 as per the screen, but probably around 2.9%. So what are you getting when you invest in the trust? You're getting a broad exposure to the global financial sector. We've given some examples here. Obviously, banks make up a significant portion of that, both large, likes of JP Morgan and TD in Canada, and some smaller mid-cap banks like East West Bank in California, or One Savings Bank, or OSB Group as it's now known in the UK. Insurance and other financials also make up a significant part of the trust, and I'll talk a little bit about those as well. Performance since launch and since a corporate action back in 2020 is shown on this slide. We show how we've performed against our benchmark, against the Lipper open-ended peer group, against a selection of UK banks, and obviously wider equity markets. So we're pleased with performance. The trust is annualized at about 10% NAV total return over that period, obviously with some ups and downs. And we still see that very much remain constructive on the opportunity going on from here. So why is that? 5 key points which I'll try and bring across in this presentation. One is the sector remains cheap, particularly relative to wider equity markets. Very much it's the beneficiary of reopening or recovery, maybe, rotation into value. Capital returns an important support for the sector as banks sort of increase their buybacks and dividends to shareholders. And critically, and probably the biggest driver for the sector at this point, is the beneficiary of higher inflation to the extent that leads to higher bond yields and interest rates. Longer term, there's some interesting growth drivers in emerging markets, smaller and mid-cap banks, and fintech payments, which I'll touch on as well. So on this slide, what I try to show here is the performance of banks during the pandemic on the right-hand side versus what happened in the GFC. And what we're trying to show is that banks have underperformed wider equity markets during the pandemic than they did during the global financial crisis. Now, to us, that doesn't make a lot of sense. Banks today are much more resilient. They've got a lot of capital, much more liquidity. You're seeing good profitability, much better risk management. And even though they've actually performed in absolute terms better, we think that relative underperformance is very much an opportunity going forward over the next few years. Why did they underperform in the pandemic? Understandably, people were concerned about the risk of a huge jump in defaults. 3 reasons why that didn't happen. Firstly, obviously, the stimulation from central banks cutting interest rates and QE. Secondly, obviously, the efforts from governments providing stimulus checks, guaranteed lending. And thirdly, banks' risk appetite coming into this pandemic was much more conservative than that preceding the GFC. So on the left, what we show here is the trend in US bank non-performing loans or bad debts. And you can see they barely rose to a fifth of the level we saw during the GFC. So a remarkable change. On the right, banks also took huge loan loss reserves to set aside for obviously expected defaults. They didn't come about to the level as expected. And banks have been releasing that through their earnings over recent quarters, hitting the ball out of the park with their results. And still at this juncture, they still have a lot more reserves set aside for slower growth or whatever, which should insulate them to some degree. Key though is obviously the elephant in the room, and obviously more recently, obviously the sad events in Ukraine and how that's going to impact on equity markets and financials, obviously in our case. You saw central banks pivot about 2 months ago. Obviously, the assumed transitory nature of inflation has proven, not to be, or not as transitory as markets and investors thought it would be. Consequently, you're seeing central banks raise interest rates at the fastest level in over 15 years. that has resulted is bond yields have risen sharply. And this is what's shown on the chart here on the left. But still are well south of where current inflation expectations are. Now that's a very good thing for the sector, and the reason for that is that banks are very, very interest rate sensitive, more interest rate sensitive today than they were, say, 2 years ago. And that's driven by the huge amount of liquidity that's gone into banks' balance sheets, driven by stimulus checks, by QE, and so forth. And what it means is as and when interest rates rise, the pressure for banks to pass on those interest rate rises onto their depositors has fallen materially because of this excess liquidity in the system. Consequently, what we're trying to show on the left and on the right-hand chart is the impact for interest rate rises on the earnings of US and obviously other banks globally. So for example, for the US on the left, a 1% increase in Fed funds increases US banks' earnings by around 17% in year one. Now, as not all loans reprice in that first year, then the impact in year 2 and year 3 is even greater. On the right, saying the difference regionally. So you see European banks are more sensitive to this, and more so than Australian and Canadian banks. Couple of reasons why that is. European banks are less profitable, so the impact of rising rates has a bigger impact on their profitability and therefore feeds to the bottom line. Also, when you're looking at the why European banks are more sensitive, and equally, why do you see this broad range for US banks? It depends how many sort of floating rate loans that they have on their balance sheet. So in the US, certain banks have more what they call C&I loans or corporate loans on their balance sheet. And in Southern Europe, you've got more banks hold floating rate mortgages, etc. So those loans reprice more quick and therefore have a positive impact on the earnings of banks. Consequently, you look on the left, the sensitivity of banks and to a slight less extent insurance to rising bond yields is the highest of all the sectors. And that's driven off by that sensitivity to interest rates. So if we're in an environment where bond yields, because of inflation expectations, continue to trend higher, are higher over the next 6, 12, 18, 24 months, then in that background, we'd expect banks to continue to perform. On the right, what we wanted to show is the correlation between banks and other sectors in the equity market. So banks are much less sensitive to sectors like tech, healthcare, communication services. So at this point in the cycle, where you've seen sectors such as tech, etc., have done very well over the last 5, 6, 7 years because obviously the fundamentals of those businesses have done well. They've re-rated significantly. You're actually getting some good diversification benefits owning banks and financials at this point. We saw this in January, where there's a sharp rotation from growth to value sectors. Markets fell. Actually, financial one thing we point out, a number of our peers are up a month. So one thing we point out, a number of peers have gone down the route of shifting their funds from having broader global financial exposed to fintech. Perfectly commendable opportunities within fintech companies, but what we argue is you're not getting the diversification benefits at this point in the cycle by owning fintech. This slide we put in a few weeks ago. Sadly, obviously, has more relevance now than it did because of the consequences of Russia's invasion of Ukraine. What happens, obviously, in an environment of much higher inflation? We've used data here from the 1970s for UK banks. Some of the data is careful to read too much into it, but the conclusions is definitely that banks are one of the biggest beneficiaries in a higher inflation and higher rate environment. Energy also obviously does well. That's also supported by the end of the 70s. Both the energy sector and the bank sector suffered windfall taxes, reflecting they were seen as obviously beneficiaries of that higher inflation and higher interest rate environment. But you've got to be cognizant that things could be quite different this time round. We're not forecasting inflation to be as high as we saw in the 70s, but it's a useful exercise to look at. Looking forward from here, one thing that also makes us positive is the sort of robust nature of household and corporate balance sheets. as a consequence of what's happened over the last couple of years. On the left, you're looking at the sort of household debt service ratio. You can see that's fallen to levels we haven't seen for 40 plus years. So again, showing that actually consumers are in a much better position to meet a higher interest rate environment. Equally, if we put charts up here for corporate balance sheets, then you'd see something similar. So either you can look at it from the point of view that that reduces the likelihood of a significant spike in loan losses as a consequence of perhaps weaker growth or the impact of higher energy and food prices, but equally potential for some catch up in growth. You know, US capex to sales is close to a 50-year low. There is still some pent up demand there, but we've got to be cognizant of the risks as a consequence of what's happened in recent weeks. Balance sheets, just to highlight, balance sheets remain much stronger than they were 10 plus years ago as a consequence of all the changes in regulation and capital requirements that we've seen over the last 10 years. As a result, you know, banks are much more resilient. You haven't seen banks fail as you did back during the global financial crisis. And then that leads feedly onto the capital return story. So banks built up surplus capital during the pandemic. Consequently, you're seeing banks increase the amount of dividends and buybacks that they're returning to shareholders over the next 12, 18 months. And for European banks, that's significant. Now, one or two, like UniCredit and Raiffeisen, because of their exposure to Russia, have dialed back the potential for capital return. But we've had confirmation from the ECB that they won't be looking to ban dividends and buybacks as they did during the pandemic. So we see this as supporting the investment case, and with buybacks being done well below book value in the case of some European banks, and it's obviously very accretive for book value, and in the case obviously also for earnings. Outside the large cap banks, where loan growth has been quite anemic in the last couple of years, sort of low to mid single digit, but we're starting to see pick up. We see perhaps one of the biggest opportunities in some sort of smaller and mid cap banks globally, but particularly in the US, where we're very much overweight. Here you can see loan growth is averaged over 20%. And these are banks that may be operating in a state which is seeing faster growth because it's got better demographics. It might be banks that are focusing on certain niches. Silicon Valley, as the name suggests, is focused on particularly in the tech sector. And so we continue to see some attractive opportunities here. And recent results have confirmed that growth is actually accelerating, if anything. Looking at valuations, so global banks have seen their valuation fall in the last couple of weeks to around 1x book value. And what we've tried to do here in this quite sort of complicated chart is we went back 25 years looking at MSCI data. So every single month, what was the price to book of a portfolio of global banks? And if you bought that portfolio in that month, what was your subsequent 3-year return? And what the surprise when we put the data together is how strong the correlation. So both pre and post GFC. The lower the price to book you paid, the higher your subsequent return. So today, buying banks at around 1x price to book would suggest, if this correlation stands, you're going to get a kind of 20 to 50, 55% return over the next 3 years. And we think that stacks up as reasonable. When you look at the tailwinds from higher interest rates, obviously, positive growth coming through in earnings, there's no reason why that shouldn't come through, but obviously cognizant of risks with recent events around that. Outside banks, our largest subsector is insurance. So this is an area we've been adding to recently. So most of our exposure is sort of property casualty companies. So examples like Chubb, Arch in the US, or Beazley, Direct Line in the UK. And this is an area that's been benefiting in the last few years from an acceleration in rate increases, so premium rates. That was a consequence of what you call a soft market going back a few years. But COVID has obviously led to the acceleration of rate increases, outpacing claims inflation. And this is usually a counter-cyclical defensive subsector. Claims are driven obviously by weather-related events, accidents, and so forth, and so therefore tends to be much less economically sensitive. So we see the setup there for the next few years as attractive, and that's one area that we've been adding to. Finally, obviously on the sort of value and growth debate, I think it's an interesting chart showing obviously, traditionally value sectors, energy and financials, that's represented, around 30% of global equity markets, and technology obviously representing growth. And what we're saying is here is not that long-term growth, in technology isn't an attractive area to invest in, but at this point in the economic cycle, we expect to see a degree of mean reversion as people switch from growth to value sectors, which are benefiting from obviously a higher rating environment. And therefore, you start to see that trend back, not necessarily to where it was, back 10 years ago, but that trend obviously is beneficial for financials at this point. Portfolio, so very much, banks is the largest exposure of the trust, including some of our investment banks, which are designated as diversified financials. We have between 65 and 70% in banks, so overweight there against our benchmark. Insurance we've touched on. Diversified financials includes things like asset managers, where we hold stocks such as Blackstone, it's a big US alternative asset manager. Payments is an area where during the pandemic we had around 15%. So when we're thinking of fintech payments, we're thinking of holdings like MasterCard and PayPal. We've reduced that over the last couple of years to rotate back into some of the more cyclically sensitive parts of the sector, particularly banks, where we see more upside. And then fixed income, which we can have up to 10% as part of the mandate, that's fallen quite materially in recent years, reflecting the sort of lack of, the shortage of opportunities with yields having come down. Gearing ranges from between sort of 0 and 12% since launch. We took gearing up to around 12% at the back end of 2020. And at the back end of last year, we started to reduce it. And now it stands around 4 or 5%. This is at the end of the month, so it's up a little bit from there. Just reflecting a little bit more caution with markets having performed very well, and obviously concerns around recent events in Russia and Ukraine. So just to wrap up, very much an out-of-favor sector, remains cheap, particularly relative to wider equity markets. Balance sheets incredibly strong. You're seeing financials, particularly banks, return a lot of that, surplus capital they've built up over the pandemic through higher dividends and buybacks. And you've got this upside from obviously a continued tailwind from potentially higher interest rates as a consequence of higher inflation coming through. So with that, thank you very much for the interest, and I'll pass back to Roland for Q&A.
First question we've got is about Russia, Ukraine, the situation. Do you have any direct exposure? Do you own any Russian or Ukrainian? And the question is also about China, any Chinese companies in the portfolio?
Yeah, so we have no direct exposure to Russia. We don't own any of the European banks that have subsidiaries or large, exposure to Russia. Similarly to China, our only exposure is in Hong Kong, so we own some Hong Kong Exchange and some AIA, which is a life assurer, so similar to Prudential. So from that point, no direct exposure. Our biggest exposure is obviously second order effects. What's the impact of higher commodity prices? And we see that as obviously inflationary, therefore more likelihood that central banks have to raise rates, notwithstanding the impact on growth over the short to medium.
Nick, fair. And if you can still hear me, Nick, you spoke a lot about buybacks and banks increasing dividends. As an investor, do you have a preference to one or the other? The question there, Nick.
Hi, I think we lost you there for a second.
Yeah, okay, sorry, let's get back now. The question was about capital returns. You mentioned buybacks and increasing dividends. Do you have a preference, one or the other, as an investor?
Yeah, it's a good question. I think our frustration, I mean, we're an income and growth fund, so in that sense, we like to see a balance between the two. And I think our frustration historically has been with European banks have been reticent to buy back their shares. When you look at valuations for European banks, trading at quite large discounts to book, we think that's been a missed opportunity. So the fact they've started to do that, there's a number of banks that have done buybacks and continue to do so, we think is a positive. But yeah, but we like to see both, really.
Okay. And next question is two-parter. We've had someone ask us for confirmation of the percentage of the fund's total assets in banks. And secondly, another question about investment banks versus retail banks. What's the split, or do you have a preference again, I guess?
Yeah, so if I go back to the previous slide, so banks, pure sort of retail and commercial banks, it's just shy of 65%. We also own 2 holdings in UBS and Morgan Stanley. So investment banks, they're designated as by MSCI as diversified financials. If you include those, then our exposure to banks is around 67-68%. And your other question? Sorry.
It was the other question was, do you have any preference? Clearly, I think we do, based on where the ownership, retail versus investment banks.
Yeah, so historically we preferred retail commercial banks. Reason for that is I suppose the consistency and sustainability of their earnings is stronger than investment banking businesses. Investment banks can have a couple of good quarters, trading comes in very strongly, and though they actually a number of them deliver good returns through a cycle, markets tend not to give them the benefit of that. They obviously seem to have a higher cost of capital, or a high beta, more sensitive to obviously market shocks. So we tend to lean towards retail and commercial. Now, having said that, during the pandemic, the investment banks did do extremely well, benefiting from that volatility, benefiting from the need that a lot of companies had to raise new capital, and they were big beneficiaries of that. So some of the big banks we own, like JP Morgan, Bank of America, also have investment banking operations and benefited from that trend.
Okay, time for a couple more quick ones. First up, do you expect to see more M&A activity in the financial sector?
Yes, I think that's likely. Certainly we've seen quite a bit of consolidation among sort of, I suppose we call traditional asset managers. They've been under pressure because of flows moving to passives and alternatives, therefore pressure on fees. So consolidation there we'd expect to continue. In banking, the US, there's still 5,000 banks, or 4,900. So again, expect to see continued consolidation among some of the smaller regionals and community banks. Europe, you've seen quite a bit of consolidation, obviously post the GFC, so perhaps less so there, but certainly it's going to continue to be a driver.
And the final question, just a quick one, conscious of time.
Yeah.
Are all the funds holdings in public companies, or do you own any private companies?
So we have, one currently, we have a small holding in Atom Bank, which is an unquoted UK digital bank. It's about 0.4% of the trust. We're currently also looking at making an investment in Moneybox, which is a online wealth savings platform, and that would be for a sort of similar amount of exposure. So actually, we've got a little bit there, but it's 99.5% effectively listed equities is how we're exposed.
Lovely, Nick. We're out of time. Thank you very much indeed.
Great. Thank you, Rowan. Thank you, everybody, for their interest.